Head fake is what it's called. The market sometimes has to do something to shake out one side in order to go up or down. It has to go up in order to go down. What does that mean? Well, if you understand the functionality of what makes price do what it does, then you'll understand why head fakes sometimes have to happen. If there are too many people short, that means there's too many buyers and it's hard to go down. Therefore, you get a shakeout of shorts with this move up here, and then it quickly comes back down, and you could say to yourself, at this moment, there are less shorts because it just shook out some on this drive higher. So you have less shorts, which equals less buyers, which just helps us go lower. That's all. Sometimes when you have this in combination of the next factor or dynamic, when you get a market to fake up, and first of all, you draw the box in here, right? There's a congestion box. You get longs and shorts duking it out, trying to fight for upside or downside. This is the low of the day. And so you get two things that happen when it pops and then drops. You get less shorts like I just ran over, and you get more longs, breakout longs that are buying it. And then you got the longs in here, but then you get the breakout longs that are buying it above this yellow line, anticipating it's going to run up. And sometimes it does. But when it doesn't, you get them to have these big grapefruit eyes to say, holy SHIT. What do more longs indicate? More selling. There's nobody that debates that. After you're long as a day trader, you are now a seller to exit that long position. So more longs, more sellers. If you have less shorts that equal less buyers below, and you connect that with more sellers, is that not the recipe for this downside? So when we play this out, and you see it in real time, this pattern, so that's a head fake. And this is a qualification of a bearish idea into a short position. Let's roll it down into here. Another thing that happened is our laser went red to green. Let's play it here. So it's just chopping back and forth. It's slightly long. They're either looking to break out. Must be too many shorts. Here the shorts come in. Our laser goes red. Our inventory chaser goes white. That's an indication of some upside. I fast forwarded it because I can't wait. Let's go right to here. All right, so it goes red, white, indication of some upside. We get this pop and a breakout through the top of this range. All right, and then watch what happens. It sits right back in and goes quickly red to green on the laser. Red to balance and then green. And then it slices through the middle of that congestion box. It's got all the longs that played the breakout saying holy SHIT. They're the sellers that are chasing it lower. It's got less shorts, which is less buyers, which makes it easier for price to go down. So it's not just about looking for a pattern. It's understanding the pattern as it's developing and why it would be a pattern in the first place. You don't know why it's going to be a pattern in the first place. And you can't take it back to the simplistic definition of why price moves in the first place. You're never going to understand it enough to execute it. You got to complete the logic circle, so to speak. It's got to come back to more sellers, less buyers in this example, because that's not something that's important for price to go lower. It's necessary for price to go lower. You have to have more people willing to sell it, wanting to sell it, and less people wanting or willing to buy it for the price of anything to go lower. That definition is lost on YouTube, and it will always remain lost. So a head fake is an important market functionality, market principle. And a lot of people think that it's personal. The market's just doing it to shake me out. No, it's the market doing what it has to do in order to continue its price discovery process.